upper circuit on Friday as well. So this is ideally the third or the fourth consecutive session where we're seeing bazaar-style retail get locked in upper circuit of 5%. But shifting focus away from that, then let's put the spotlight on a corporate conversation and onto the hospitality sector. Lemon Tree Hotels is in focus on the back of their earnings. It's largely been a mixed bag coming in for the company, where the revenue and PAT have been in line with what the street was estimating. The ARR growth has been slightly weaker than estimates, but occupancy at north of 75% in the quarter gone by, looking good for the company. Let's try and break down these numbers and, more importantly, give you a sense of what the outlook is going ahead. What is the room addition plan, the Fleur demerger, any update on the timeline? So much more to discuss with Mr. Neelendra Singh, the Managing Director at Lemon Tree Hotels, joining us on the show. Mr. Singh, hi, good morning, and thanks for your time on the show. Good to be speaking with you for the first time. And give us a sense on how this quarter has shaped up for you. Quarter one has largely been a mixed quarter for you, because if I talk about the average room rate, that declined 15% on a sequential basis to 6,261 crore rupees despite healthy occupancy. If you can just give me a sense of what drove this sharp sequential correction and how quickly can pricing recover?
Well, hi, Sneha. Good to speak to you as well. So you're right. First quarter, a little bit of a, let's say, hiccup for the industry, Sneha. It didn't start at in the right note by the end of March or at the beginning of April. However, I guess the quarter was largely resilient for the industry, for us as well. We were able to pick up a fair amount of occupancy towards the mid of the quarter, and in June, while you're right, the ARR were largely soft because of demand being soft. The sequential, let's say, change in ARR that you talk about is natural, Sneha. This is, let's say, the first quarter of the season, or Q4 of the prior year is the largest quarter. So as we move from Q4 to Q1 of the next year, typically ARRs do become softer. So nothing to worry on that. It's just seasonality of winter and moving into spring in that sense. But you're right, mixed quarter, and Q2 looks much better.
Hi, Mr. Singh. Metal here also joining in. You've said that Q2 looks much better. But can you help us with how the on-ground traction is looking like in terms of demand as well as occupancy? Any color you can give us on that front?
Sure. So I think first thing first, like I said, let's start with Q1. Q1, I guess, was unnatural because of the West Asia crisis, and largely the demand softness because of less travel and less corporate travel, especially in the mid-scale segment. And you know, when we in our chain, most of our business hotels are concentrated in large metros, so we literally saw demand become soft at the middle of the quarter or the early quarter, and that drove the softness in price. Q2 actually started very well, and we can see both better demand, as in better occupancy, as well as better ARR traction. So seems like we're back on track, and I think the industry is back on track in many ways. And you could expect certainly a better traction in Q2.
Hoping for that. Let's also talk about occupancy. You know, that improved on a year-on-year basis but declined sequentially. I'm just trying to understand, because of the West Asia crisis, we didn't have a lot of people traveling internationally initially, and the focus was domestic. Also, the summer vacations were at play. Just trying to understand what's the outlook on occupancy, how has this summer been compared to the last, and across leisure, business, pilgrimage, how are you doing across all of those segments?
Great. So yes, we did see that the inbound traffic decreased because of West Asia conflict. We're not very dependent on the West Asia, or let's say the inbound traffic in that sense. However, the second order effect was quite significant because of lesser, let's say, business travel in Q1. Q2, to answer your question, Sneha, we see both leisure travel and business travel broadly back. Some companies on some cities appear softer, but I guess that's a function of some companies, you know, resuming travel as Q2 starts or as we get into Q2. But in general, leisure, pilgrimage, business, all kind of demand is on a positive swing at this point of time. Even in Q1, just to add a little bit of color, despite the traffic, and to your point around more leisure travel in Q1, we did see that our leisure locations saw a higher demand and therefore higher conversion, both in terms of occupancy and ARR in Q1.
Got that, Mr. Singh. Can you also help us reconcile this one little bit? RevPAR was up about 6% on a year-on-year basis, and this was despite a 12% increase in room inventory. Can you tell us how we should think about like-for-like growth in RevPAR growth versus growth from new rooms coming in for you?
Oh, okay, great. So the room inventory that you see is of the entire fleet. I think is largely on the on our third-party managed hotels. The RevPAR 6% RevPAR increase that you see is on our own hotels largely. Then and the two ways to look at it: the broader RevPAR increase across both our managed hotels. Third-party owned and managed by Lemon Tree Hotels and our own hotels was in the late single-digit range. So let's say similar to 6 to 8% RevPAR growth. The 1,200 let's say room inventory increase that you see is the rooms that we opened since last Q1. We typically in a year ballpark we sign about last year, let's put it this way. Last year, we signed about 4,900 rooms and we opened about 1,500 rooms. And therefore, the delta that you see between inventory between this Q1 and the last Q1 is the rooms that we opened over last years. And hence, you see that our network revenue is much larger. The growth is much larger because that includes both same store or like-to-like growth plus the scale growth through addition of new rooms.
Okay, understood. And Mr. Singh, I was just looking at your management fees. For the quarter gone by, that has grown at 21%, which is significantly ahead of your overall top line growth. I'm not trying to draw a correlation, just trying to understand, can this outperformance continue as your managed and franchise portfolio scales?
So yes, you will see that, Singh, and that's again, I'll explain that. See, typically the management fee is a function of two large levers. One, the hotels that we had operating last year and this year, which is called the like-to-like, and the other, the scale that we picked up over the last 1 year, which is essentially the 1,200 rooms ballpark that we talked about. So when you see a 21% increase in management fee is a combination of both the same store growth or like-to-like growth of the existing fleet that we had last year, plus the scale that we've acquired and created in the last 1 year. So it will always, on account of these two factors, be larger than like-to-like growth.
Got that, Mr. Singh. Also tell us, of the 23,000, approximately 381 room pipeline, how much of that is already under construction or has clear opening timelines set? And what portion of that remains at an early stage? I want to understand how many will open up before the end of FY27. What's the number that you're envisioning on that?
Great. So again, I'll go back to what I said. We in a typical year, you could expect us, or at least in this year, we've said that we should be ballpark opening or signing, 5,000 rooms and opening in the range of 2,000 rooms. The inventory that you see of 11,435, which is basically upcoming rooms, will take about 3 to 4 years in general. When we sign a hotel, it takes about anything from 30 months to 40 months to open it from the date of signing. And therefore, as we keep signing and accelerate the pace of signing, you will also see that the pace of opening increases over the years. This year, we've said lately that we should ballpark be in the range of 2,000 rooms in terms of opening. There's always a little bit of a risk in terms of construction timelines and compliances, but I believe we would be around that range by the end of this year.
Okay, understood. So that sounds good. And Mr. Singh, I have to ask you this. Can you give us an update on what's happening on the Fleur demerger? What is the timeline looking like right now?
All right, great. So Fleur demerger is up for approval. It's a long timeline. We should be looking at all the approvals in the bag by early next year. So hopefully, we should be looking at listing by Q2 next year.
Listing by Q2 next year. That's definitely something that we're going to be tracking, Mr. Singh. One last question, actually, from my end. Given the growing share of managed as well as franchised hotels, can you quantify the long-term margin and also the return on capital benefit of the asset-light strategy that you're employing versus the existing owned and leased portfolio?
Great question. So look at it this way. as we grow in the managed side of the business, what we essentially are managing a property and providing Lemon Tree as a platform. And what does Lemon Tree offer? Lemon Tree offers distribution, marketing, the brand, and therefore operates the business for our owner partners. And I don't want to quote a number, but in a business model like this, you would see that the corporate cost or the cost of don't increase at the same pace as the scale of the business grows, which means essentially the room count, the fee income, and hence such businesses. And this is a pretty well executed business model in the West. In such businesses, the return on capital is huge.
Okay, understood. We are going to be watching out for all of these developments play out. And of course, the Fleur listing is something that we're all very excited about. Mr. Singh, wonderful to be speaking with you. Thank you for this interaction and hope to interact with you once again very soon. Good luck.
Thank you so much, both of you.
Thank you so much. On that note, viewers, time to slip into a very short break on this edition of Midcap Masala on the